Hello, welcome back to another week of market updates. This is Kelly coming to you on July 28th, 2023, Friday afternoon here. So let's jump right into our economic updates. This week was full of economic data as well as a really important Fed meeting on Wednesday, the July FOMC meeting, where they announced another rate hike. And so as we near the end of July, I figured we should pan out a little bit and see how equities have looked over the month or so. And so as of July 27th, Thursday, the S&P 500 and the NASDAQ composite picked up about 1.9% each. The Dow Jones Industrial Average pulled ahead, actually 2.54%, which is very unique given the NASDAQ's run-up this year, and the 10-year U.S. Treasury yield pulled up 5.25%, and largely this was because the spike right after the Fed meeting, and before that, the rise was much more subdued. So really interesting stuff to see as we look at market performance over these last few weeks. Shifting gears into our economic updates of the week, we had consumer confidence for the month of July. It rose 6.3%, quite a big spike there, you can see, and this was following another rise in June. Consumers are really starting to worry less of a recession, and this marks the highest level in consumer confidence since July of 2021. I think it rose largely because of consumers' confidence in employment markets, which the data showed, and that's justifiably so because the June unemployment rate was just at a low 3.6%. And similarly, 47% of consumers surveyed in this believed jobs were plentiful, which was up slightly from June. So overall, the picture that consumers have of the economy is increasingly becoming much more bullish as they feel more comfortable in their situation and they're less worried about employment markets. The biggest news of the week, but also the least surprising, was the July FOMC meeting, where Jerome Powell announced a 25 basis point rate hike right here. You can see that tiny little stair step up we took here in late July. Going into the meeting, markets had priced in an over 99% chance of this rate hike, so we were very much not surprised when Jerome Powell announced this, and that brought the total target federal funds range to 5.25 to 5.5%. So quite high, quite historically, a tight environment for borrowing. Besides the largely uneventful Fed meeting, where there was no substantial changes to the policy statement and the rate hike came just as expected, I found this piece really interesting about Powell and just how we look at it, Powell and the Fed chair in this very Fed-centric economy. So here you can see the number of FOMC dissenting votes, basically the popularity vote, right? So if they have more dissenting votes, more votes against what the Fed chair is saying, what the Fed chair is believing, they are basically less popular. So not that this matters a whole lot, but we can see here that the other Fed members really have trusted Jerome Powell and his guidance of the economy and his rate hike decisions and such. And you can see Paul Volcker was the last Fed chair in a really high inflationary environment in the 80s when inflation was up to nearly 15%, and he was incredibly unpopular. And, I think the 8 years that he served as chair, he had 92 dissenting votes. Fed Chair Powell has been in for 5 years, and he's only had 13. So you can see here that the Fed members seem to really trust Powell in the midst of a pandemic, in the midst of really high inflation. And maybe that means that consumers trust Powell, and maybe that means in some scenario that we might get a soft landing. So really interesting stuff to think about as we look at this Fed-centric economy and how markets are interpreting the Fed. Shifting gears a bit here, June durable goods orders came in higher than expected at a monthly increase of 4.7% compared to May, and more specifically, non-defense aircraft orders led this growth. So they were up 69.4% in the month as major airlines are really struggling to secure enough planes for their growth, for their operations. And I think overall, there's no question that industrial demand is starting to stabilize, and it's not as much of a concern for economists as it was maybe 6 months ago. You can see here we've had 4 straight months of month-over-month growth in durable goods orders, which is pretty strong given the overall economic environment. Also this week, we got the personal income, spending, and saving report for the month of June. We saw personal income rise about 0.3% here, while personal spending rose 0.5%, so a bit larger of a pickup there. As well, we saw the personal savings rate drop down a bit to 4.3% as consumer spending picked up faster than their incomes. In any case, we've seen this moderate wage growth and overall consumer demand remain pretty strong, which is another win for those taking a bullish stance on this economy. Along with CPI and PPI coming in, the personal consumption expenditures inflation fell substantially in June to a headline rate of just 3%, similar right on track with the CPI numbers, and a core PCE rate of 4.1%. On a monthly basis, we saw PCE and core PCE up just a mere 0.2%, and this comes as the Federal Reserve might be at the end of their rate hiking cycle, and other leading data such as the producer price index, the producer inflation, kind of shows lower inflation coming on the horizon. So this is really interesting as the Fed, is really close to the end of their hiking cycle. The probabilities of another rate hike for the September or the November meetings is about 30%, give or take. So right now, this might be the end of the rate hiking cycle as we see this inflation data come down as well. One final way of just looking at all this data as we look at the markets each and every day, as we consider, all different types of tactical, technical, fundamental analysis as we form our opinions on portfolios, on the macroeconomic environment. Here we can see we have a tactical scoreboard of 40 key factors, and things like consumer confidence up, the durable goods up, inflation coming down. That's all really good. And you can see from our tactical factors, we're at an 85% bullish stance in just our short-term outlook of how the market is viewing data right now. So I think this week was a big week for the bulls as we got a lot of bullish data coming in and we had inflation dropping off. We got another 25 basis point rate hike from the Fed, and we also had a lot of other positive data. So overall, we're getting a much more bullish stance just in the short term on this economy as kind of this data comes in much stronger than expected and shows a resilient consumer. So we appreciate you tuning in to our market update this very, very busy week, and we look forward to seeing you next week.